What is going on, y'all? This is Pay Me in Dividends, and today is December 2nd. Man, this year has flown by so quickly. We're already in December, right? December 2nd. So let's get to the video, right? There's a couple things I want to talk about today, but very quickly, we'll just look at my portfolio very quickly. I'm sitting at $84,680. My holdings have not changed since my last video. I still hold 1,000 shares of AIPI and 1,000 shares of MSTY, right? So about $50,000 in AIPI and about another $32,000 and some change in MSTY. But what I wanted to talk about today is how to generate a predictable $1,000 a month in dividends. And notice how I use the word predictable, right? Not necessarily reliable, because you got to remember, when you invest in these high yield stocks or ETFs or closed-end funds, nothing is certain. But I do feel like this list that I've prepared today are some ETFs and also CEFs, closed-end funds, which we're going to get into here in a moment. And these have been pretty reliable as far as a consistent monthly payout. And so it's very predictable, right? Like the last video I made, I talked about portfolio anchors, right? Having stocks in your portfolio that pay high yields, but also have predictable monthly distributions, which is important, especially if you want to eventually use your portfolio to retire or live out of, or to pay reoccurring monthly expenses. You want to have something that's predictable, right? And so this is what we're going to talk about in this video. So before we get into this list of ETFs and closed-end funds, I just want to give a quick rundown of what a closed-end fund is, right? Just so you have a basic fundamental idea of what it is. So a closed-end fund is a type of mutual fund that issues a fixed number of shares through one initial public offering, right, one IPO, to raise capital for its initial investments. In contrast, an open-ended fund, such as most mutual funds or exchange-traded funds, ETFs, right, this is something that we're a bit more familiar with, accepts a constant flow of new investment capital. It issues new shares and buys back its own shares on demand. So this is something that you can do a bit more research on your own about, but this is just kind of a fundamental breakdown, a very basic breakdown of the difference between an ETF and a CEF. And the reason why this is important is because you want to have a basic understanding of what it is that you're investing into, right? It's good to have a good history on the investment that you're making. It's good to have a good dividend payout history, but you also want to have an idea of what these funds do and how they are and what they're made up of, pretty much. So this is just a very basic breakdown. Again, you can do further research on this on your own, but I just wanted to kind of start off with that just so you understand the fundamental difference between a closed-end fund and an ETF. So let's get started on this list, right? A couple of these I know you guys are familiar with. I've talked about these in other videos: AIPI, FEPI. Giax is actually a new one that I came across. Shout out to the entrepreneur investor. He actually just made a video on Giax, and I actually found it very, very good. I found it very interesting, and I really like this fund. It is a newer fund, but it does look very reliable. It does look very predictable and consistent. So we're going to get into that. And then down here on the bottom, you'll notice UTG and UTF. Now, these dividend yields are a lot lower than your typical high yield ETFs that we typically talk about, but they are very consistent and they do have some history behind them. So we're going to start off with these two on the bottom and then work our way up. And also what I want to do is I want to calculate how much investment, how much principal you would actually need in each of these ETFs in order to generate $1,000 a month in dividends. So we'll go ahead and start off with From the bottom, we'll start off from the lowest yield and work our way up to the highest yield. So we'll start off with UTG. Now, UTG, this is a utility income fund, right? The fund's investment objective is to provide a high level of after-tax income and total return consisting primarily of tax-advantaged dividend income and capital appreciation, right? So when we look at this, you can see that since the fund's inception in 2004, shareholders have received more than 1.5 billion of cash distributions. So you can see that this has almost 20 going into 2025, almost a 21 year history backing it up. So that's pretty predictable income right there, right? So when we look at the payouts, we can see that it is very consistent. It's at 6.5%, and they do pay monthly. As you can see, they pay here monthly. If you look at these dates, and you can see that the payout has been very, very consistent, and it's actually increased a bit over time. It doesn't look like they increase it every single year, but as you scroll down, you can see that they do actually increase it. So since the year of 2004, you can see that they started off paying about 9 cents a share. In 2005, 10 cents, and so on and so forth as you scroll up. Let's see when was the last time they actually made an increase. So their most recent payouts are at 19 cents, and it was at 18 cents back in 2021. So it's been a few years since they've increased it, but nonetheless, the payout has remained the same. So I do think that this is a pretty good close-end fund to look at, right? It's at $34 a share. The price does appreciate over time. If you look at the chart, we can take a look at the chart very quickly, and we can see that let's go chart, or let's see if there it is. All right, so we can see year to date, it's actually up 27% this year, which is very good. And if we zoom all the way out since inception, since February of 2024, it's up 94%, right, with that consistent dividend. So this is one of these close-end funds where you do actually get some capital appreciation over time. It's not going to go up as much as the S&P 500 or the NASDAQ or big tech stocks, but you are going to get some capital appreciation. And in 2024, it's actually done very well. So it's actually right up there with the S&P 500 as of this year, while providing that 6% monthly dividend payout. So this is one that I think you should put on your watch list. It's a close-end fund. Again, it's a bit different than what we typically look at in these videos, but I do think it's worth putting on your watch list and taking a look at. So that one was UTG. We'll move on to the next one, which is UTF. So UTF is from Cohen and Stairs, and the primary investment objective of this fund is total return with an emphasis on income through investment in securities issued by infrastructure companies. And if you go on their page, you can actually look at their holdings, right? And you can see the different industries that this fund actually holds. It looks like 35% of the fund is electric. Then you have corporate bonds, midstream, gas, tower, airports. And if you notice, compared to AIPI, right? Let's look at the holdings for AIPI. This is mostly tech and AI. Palantir, CrowdStrike, NVIDIA, Supermicro, Computer, Salesforce, IBM, right? So these closed-end funds give you a bit of diversification, right? Because we're in such a tech era, which is good because tech is really going up in price, which is a good thing. But this right here gives you a bit more diversification in other industries. So if we look at the distributions, we can scroll down here, and let's go all the way to the bottom, and we can see that they've been paying out since 2016. So about 8 years now, they've been paying out pretty consistently, and it is a monthly dividend payer. Now, as you can see here, the dividend payout really has not changed since inception. It was around 13 cents. It looks like they gave some special payouts somewhere around here, but it was around 13 cents, and then it jumped up to 15 cents a share in 2018, and since then not much has changed. However, again, it's a very consistent payment. You know what you're getting, and so you can easily calculate exactly how much you need to invest in order to generate that $1,000 a month. So the next one, and what we're going to do at the end of the video, I want to see how much principal you would actually need to generate $1,000 a month from these funds. But I just want to look over these funds very quickly first, and then we'll go back and use the dividend yield, the current dividend yield, to calculate how much you would actually need to invest in order to generate that $1,000 a month. So the next one we'll look at is QQQI. This is from Neos. They also have the SPYT income ETF, which we've looked over before. QQQI pays a slightly higher distribution. I believe SPYT is around 12%, which is a really good ETF as well. As you can see, 12%. But I want to look at QQQI today because we've already spoke about SPYT. And as you can see, QQQI came out earlier this year, January of 2024. And if we go down to the monthly payouts, we can see since inception, February of 2024, 59 cents, 60, 58, 61, 62, and so forth and so on, down to the most recent payment at 61 cents. So you can see that this has been paying out very, very consistent, very reliable. There's not much variation. You pretty much know what you're going to get on a monthly basis, right? And so it's easy to predict exactly how much you need to invest in order to generate that $1,000 a month in dividends. So that was QQQI. We'll move on to SPYT. We won't spend too much time on SPYT because we spoke about this in my last video. This one is paying out 20%. And I really like this one. The assets under management is beginning to increase. Again, like I spoke about in my last video, I would really like to see this net asset touch 100 million. That would make me feel a bit more comfortable putting my money into it. But as of now, it has been performing very well. The share price has been very stable. It's been hovering around that $20 range. And every month has been very consistent on the payouts. As we can see, 34 cents, 32, 33, 33, 33, all the way down here to its most recent payout, which looks like it'll be paid out in 2 days on December 4th. Today was actually the ex-dividend date, and you can see it's 33 cents a share. So very consistent. You get a 20% dividend yield, which is very good. And so you can predict what you're going to make every month with an ETF such as SPYT. So we will move on to Giax. Now again, I saw another YouTuber, entrepreneur, investor talk about this recently. And, it was a really good video. And so, it made me kind of do my research on it. And I like this one, right? I've never heard of this fund manager, X Funds by Nicholas Wealth. But it does look pretty promising. If you look at their payouts, now they've only paid out 4 times so far. According to their website, they've only paid out 4 times. But you can see that the payments are very consistent. 40 cents, 40 cents, 39, 39. So I would like to see a few more months of consistent payments. But as of now, it looks really good, right? And they are paying a 24% dividend yield. Now the net assets is a bit low, right? It's at about 39 million. SPYT is a newer ETF as well and is at 79 million. So I would like to see Giax catch up, maybe hit that 100 million mark sometime in 2025. That would be very comforting and make me feel a bit more comfortable putting my money into this fund. but this is definitely an ETF that's going to be on my watch list because of that 24% dividend yield, and the share price has been very, very stable. It almost reminds me of a slightly higher dividend yield of SPYT because of the similar share price. They're both about $20 a share, but GIX has a slightly higher dividend yield. So GIX, I think this one is definitely worth putting on your watch list. Now, the next two we're going to talk about is FEPI and AIPI from Rec Shares. So we'll start off with AIPI. They are paying a 34% dividend yield. And if we look at their payout history, we can see that it's been very, very consistent, right? $1.48, $1.46, $1.48, $1.47, and November was at its highest, $1.51. So it's had a very, very consistent 34% dividend yield distribution rate. And we can see its holdings down here, right? Palantir, CrowdStrike, NVIDIA. These are all big tech companies that we've heard of, right? IBM, Supermicro Computer. So this is definitely one that's worth putting on your watch list. And you guys already know that that makes up more than half of my current income portfolio. I have 1,000 shares of AIPI. It's been treating me very well. It's been paying very good dividends, and that $50 share price does not fluctuate much, which is really, really good because you can continue to accumulate shares and you pretty much know exactly what you're going to get on a monthly basis because of that constant and consistent dividend payout. Now, also by Rec Shares is FEPI, right? FEPI. Now, this one has a bit longer history than AIPI. The dividend yield is a bit lower. It's at 25%, but it does have a longer payout history, right? They've been paying out since November of 2023, so it's been about a year now since they've been paying out. And as you can see, it's been very consistent. They've been paying out $1 and some change a share consistently every single month since inception. So FEPI is definitely another one that you want to have on your watch list. I'm sure you guys have seen this one before. I've talked about it before, but I believe it's talked about so much because it's just so good, right? And hopefully it keeps going. It keeps doing its thing. But what I want to do now, right, I want to pull up the calculator and I want to see exactly how much money you would need to generate $1,000 a month in each one of these funds. So I'm going to do some quick math. I'm going to show you guys how to do some quick math and how to figure out exactly how much principal, right? How much of initial investment you would actually need in each of these funds in order to generate $1,000 a month. So we'll start off at the bottom with UTG. Now, UTG is definitely going to take a lot more money than these up top. So we'll start down at the bottom. So with UTG, so $1,000 a month is 12 grand a year, right? So you want to go 12 grand and you want to divide it by 6% dividend yield. So you would need $200,000, right? If you times it by 6, you get to 12,000, right? So 12,000 a year divided by the 6% dividend yield, you would need $200,000 invested in UTG in order to generate $1,000 a month. Now that is a lot of money, right? But let's look at something like the S&P 500, like a VOO or a VTI that pays a 1% dividend, annual dividend, right? So $12,000 a year, that's $1,000 a month divided by 1%. You would need about 1.2 million in VOO or VTI in order to generate $1,000 a month, right? And they actually pay quarterly, so you would get that distribution 4 times a year, $3,000 4 times a year. So you would need a lot more in something like VOO or VTI, which is a low-cost ETF based off the index, right? So 200 grand isn't bad when you compare it to an S&P 500 index fund, right? So now we'll move on to UTF at 7%. So again, we'll go 12 grand divided by 7%. So for this one, you would need a bit less, $171,000 invested into UTF in order to generate $1,000 a month, right? So as you can see, these two closed-end funds, they are very reliable. They do have a bit of history behind them, backing them up, but you do need a nice chunk of money in these funds in order to generate the $1,000 a month. So we'll move on to QQQI, right? So now it's double UTF's dividend amount. So we'll go back $12,000 divided by 14%. So for QQQI, now you're down under $100,000 needed to generate $1,000 a month. So for QQQI, you would need $85,000, roughly, based off of today's dividend yield, right? So now we'll go with SPYT. We'll go $12,000 a year divided by 20%. Now you're looking at $60,000, right? So as you can see, as the dividend yields increase, the amount of principal needed to generate the $1,000 a month decreases, right? Which is a good thing. So for SPYT, it was $60,000 needed to invest into SPYT in order to generate that $1,000 a month. Now we'll go to Giax, which is 24%, right? So we'll go back 12 grand a year divided by 24%. And that gives you 50 grand. So now we're down to 50. We went from 60 grand in SPYT down to 50 grand in Giax, right? Now these are starting to become a bit more relatable to the regular person, right? The regular person who's just investing consistently, maybe every 2 weeks when you get your paycheck, you throw some money into your brokerage account. Now it's becoming a bit more realistic, right? You can kind of see the light a little more. So let's go to FEPI, right? 25%. So 12 grand a year divided by 25%. Now we're looking at $48,000, right? This is something that you can accomplish within a year or two, maybe 12 to 18 months, depending on how much income or how much contributions you can make to your brokerage account, right? So now it's becoming very realistic. Now AIPI, 34%. Now this one right here is really going to hit home, and it's the reason why it makes up majority of my portfolio, right? So we'll go 12,000 for the year, which is $1,000 a month, divided by 34%. Now you only need $35,000, right? We started off at UTG where you needed 200 grand in principal to generate $1,000 a month in dividends. And now we're at AIPI where that gets cut by a fraction, and now you only need $35,000, which again is very realistic. It's very achievable within 12, 24, or 36 months, right? Especially if you reinvest your dividends while continuing to contribute to your brokerage account. So for AIPI, you would only need $35,000. And again, guys, when I say only $35,000, that's still a lot of money. But again, it's achievable for the regular person if you set a goal and you say, hey, within the next 12, 18 months, 24 months, 36 months, I'm just going to put my head down. I'm going to go hard, and I'm going to put as much money into my brokerage account as I can so that I can accumulate these shares and I can get paid $1,000 a month consistently, right? And then now you have an extra $1,000 a month that you can put towards bills, or if you don't need it for expenses, you can continue reinvesting it into your portfolio and begin to diversify and pick up some other income generating ETFs and closed-end funds and different dividend stocks like the ones we talk about. So that's it for this video. I just wanted to give you guys a breakdown of a few of these funds. I thought it'd be fun to throw in these closed-end funds down here, although they are lower dividend yield than what we typically talk about. But again, maybe you're already generating $1,000 or $2,000 or more a month in high yield dividends, and now maybe you want to lower your risk and mitigate some of that risk and smooth out your portfolio, and now you want to look at some that are a bit lower yield than some of the 50 or 100% yield max funds, but now you can kind of smooth out your portfolio and get a bit more consistency and a bit more predictability in your portfolio. So that's it for this video, guys. I appreciate you guys watching again. Also, I appreciate you guys subscribing to my channel. I want to say about 2 or 3 weeks ago, my subscribers was at 99, and I was so grateful, man. I was so grateful because I was like, oh man, I'm about to hit 100 subscribers. And I woke up the next day, again, this was a few weeks ago, I woke up the next day and I had 100 subscribers, right? And now, just a few weeks later, I have 227 subscribers. So I just want to thank you guys for continuing to watch my videos. I plan on continuing to pump out some more videos, especially as 2025 is around the corner. I'm really working hard to grow this channel and just try to be creative and find different things to talk about that other people aren't talking about. It's kind of difficult in this space because everybody's kind of talking about the same funds because they're all so interesting, right? They're paying so much money, and the market is just crazy right now. And with crypto and everything else going on in the world, the stock market is just very, very exciting place to have your money in right now. But I'm going to continue to find creative ways to make videos. And again, I appreciate you guys subscribing. I appreciate you guys checking me out. If you are not subscribed, consider subscribing. Let me know in the comments what you guys think about my videos, and I will check y'all out in the next video.